All right, we're going to get rolling then, guys. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes a promotion, a recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionstraining.com, to read characteristics of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on specific or identified dates. Your results may vary. By accessing this webinar, you agree to hold the above harmless, and losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, now we can start a webinar. So step number one, I will now share my screen. We'll make sure everybody can see it. When you're chatting, please use the chat box, folks, the one that says chat, not the one that says Q&A, and share. Hang on. And also, before I lose the thing, also please make sure you do chat to all participants so all participants can see what we're talking about. Hopefully you'll see my screen in a minute, and it's black. Oh, wait, something's happening. Oh, okay, so now you see this boring screen. Hang on a second. I need to bring the chat box back up. There we go, success. Fantastic. Hey, professional broadcasting. Oh, son of a bitch. I don't know if you guys can hear that. That is so loud in my headphones. Just pop up that will not stop. And I have an ad blocker too. So where are we? Okay, real quick look at the futures. We failed the 2,000 line. This is all what we expect. I mean, certainly on the first day, you can call it consolidating. You don't have to call it failing. It's just at this particular moment we're below. But when you hit a major line like 2,000, the chance of going straight over it and not pulling back is pretty much zero. It's so rare that something like that would happen. How does one get the audio? I imagine he means audio. Somebody please tell Yodi that to reboot if he doesn't have audio, because I don't really know any other way. It should be audio. Anyhow, so where are we? Let's take a look at the broader view for just a minute of the charts. And where are we now? We've got okay, so everybody's, I mean, look, you know, we're up a quarter point for the day. You can't complain about this stuff. The Russell's up 1%. That's fine. That's why I shorted the Russell just now. We failed to hold the 2,000 mark on ES, which is a life and death critical thing to hold. But again, like I said, don't forget, in the broader picture, and we'll look at stock charts for a second now. Oh, here we go. There. Take a look at SPX. You know, you always have to manage your expectations. I mean, we're having a huge run. We're up 33% from last year, where we were at 1,500. So this is last year. We started at 1,500 back in January, right? Look what happens. You hit the 1,500 line the first time. You pull back. You get a little consolidation down here in this general area. This is an overshoot below. The real consolidation line is right here around what is that, 14 something, about 1450, 1420, whatever. So you know, it ran up from wherever, it hits this thing, it pulls back to 1420, which is not much of a pullback, and then it's ready to go. The next time it goes, it makes it over, it still consolidates a little, and then finally starts to get going, gathers steam, and moves on. Now we're at the next major inflection point. We tested 2,000 here. We had a little tiny pullback, but not enough that you'd think that it's good, that it was good consolidation. And then we're back here again. Probably we're still going to get back to this 50 EMA at 200-day moving average at 1900 before we get a real pop up. Okay, and even so, I mean, this is a pretty exhaustive run. We've gone up really far, really fast. Oh, great, good. Welcome, Yodi. All right. So what's next? So back to the chart. That's correct. All right. So anyway, so from a futures perspective, I mean, you know, don't forget that that was a weekly chart or a daily chart, weekly chart we just looked at. You got to have your time frames in order. You can't expect in the same day that you touch 2,000, you're going to go flying through it. You're bound to get some pullback. That pullback, though, especially when you're playing in futures, is where you can make some really good money because it isn't much. But, you know, just these little plays we've been making today, I think these were all bear bets. I'm pretty positive they were all bearish bets. So this one's the one I just put in, I think. Yeah, still got too short here from 1172. We played the Dow. We played it wrong. It went too far over. We doubled down, and we caught it. We kept it to our conviction here, and we caught the wave back. And then we got out with a little profit, with 180 profit on that one. And on oil, didn't do much. Just picked up a $70 profit on oil. Not very exciting. You know, so we just just hitting and running on these plays today. Now, I haven't had time, of course, to sit there and do it all day. If I did, I would have probably had a little bit more fun, especially with the oil, frankly. But that was right when the market opened. So in the morning, I mentioned oil was probably done at 94.30, but I didn't have time to play it myself. All I played actually was this bounce. I played this bounce from 93.50 to 93.60 something, and that was all I got, $70. You know, the whole point of the futures is you got to have time to play it. And when I'm working, I don't really have time. So, like, you know, once the session starts, it's pretty rare I make any futures plays unless I really think we're going to be missing something. So here we are at 17. If the S&P was stronger, I would want to play this four bounce, but it's not. The S&P is 1998.50. That's an inflection line. If they fail 1998.50, and they did right now, this guy's going to fail 17. And this is what I mean by laggards. You want to have other indexes you're looking at. Let's change this to the NASDAQ since oil is not that relevant. You want to be watching your four major indexes. You can't watch the NYSE, so not in futures anyway. And so you got to pick your spot. So we're going to say 68.50 is a spot, 98.50 is a spot, and 172.50 is a spot. So I'd have to say there's a high percentage chance that we're going to get some action on the Dow. So I'm going to pop in, whoa, 5, stop. Damn it, I was set for 5s. That's terrible. I did not want to be short 5. All right. This is how you can lose your money in 10 seconds. Boy, we'd be a tiny bit wrong with 5 contracts. But anyway, so things are going well because here you have 1997. You see that? That's good. 71.5. Now I'm just going to keep track, and as long as my other guys are going down, I feel good about my short position. When they stop going down, I'm going to get out of my short position. All right, because look at that. There's $50 right there in 10 seconds, and then I didn't intend to make 5 contracts, but still. So all I want to do now is make sure every tick on each one of these guys is taking me lower, and as long as they're all ticking lower, I'm confident in my short over here. If they start ticking back up, I'm going to lose my confidence. I'm going to want to get out of the trade. Now, I'm also going to watch these lines. This is where these lines are super useful. Here is a support line. So he's got a good chance of bouncing here. So 466 is going to be a place where I'm going to have trouble getting past. Doesn't matter if these guys are hanging in midair. It matters if 466 is not a comfortable line for me to get much below. So I want to lighten up already. Even though I only got $75, I didn't really intend to have 5 contracts. Whoa, wrong one. Stop. Okay. I did not intend to have 5 contracts. I'm not comfortable with that. So I'd rather get back to like 2. Here we go. Nice. Thank you. Ah, okay. Oh, there it goes. All right. So I only wanted to have 1 or 2 contracts short. I constantly lose money when I do this for you guys. Too busy talking or getting to some other topic. But now we've got our 2 short, and so you see that you're, in fact, testing the 66 line. That 66 line breaks, and we're really sorry that I brought back those couple of contracts because he doesn't look healthy. He's okay. He's now the laggard. Now, you see, that's another thing. Now, who's lagging now? He curled over, and he curled over. All right, so what have we not done? We've not, we have a new laggard now. And that's going to be the Russell. And I'm already short the Russell, so I'm just leaving my position where it is. I already expected that before. So I haven't changed my Russell bet. All I did was add the Dow bet, which also reminds me that I shouldn't really be playing Dow if I'm already short the Russell. Sorry about that. All right. And now we're still watching. We expect it bounce. So all right, now he turned green. I don't like that at all. He's at 97.75, so it's time to get out of this trade. All right, so we're just going to ditch if we can. Ditch. And if I'm lucky, I'll fill that other one. Okay, it does sound like a slot machine, you're right. Yeah, I forgot to take my phone out of the office, which I usually do, so it rings in the other room. Let's see. All right, and so just because it's not filling my position here, I want to get out of this. I made a decision. So just because my decision didn't work, where I clicked, it doesn't mean I stick with it. I say, okay, I'm going to make $10 less and get out here. All right, I got out because I was feeling bad about it. That doesn't mean if it doesn't fill my position where I tried to get out, I don't sit there and wait for it to come back. The whole point is it's probably not coming back. All right, I don't like him being green. I don't like him being green. I don't like him being green. So wait a minute, I should get out of this one too. Let's just get out of that. Good, there you go. Now I feel better. So now I can go on with the show. That's what the futures are about, though. It's like to take a little money off the table. So now it's 60 here, 230 here. Didn't play the NASDAQ. There's some money on oil. Whatever. But it's like, it's just like having a little bit of fun while you're doing other stuff in the market. You can get bored. These long-term positions can be like watching paint dry, right? All right, so now back to the paint drying, because that's our main topic for today. We're going to talk about paint drying. All right, where are we? We have our old game. I didn't sign into it. Sorry. One second. All right, we've got see what our portfolio is play for a minute, and then we'll get back to the plan. All right. I always expect the short-term portfolio to be doing worse than it is. It's weird. Really have to think about this. All right, so here's our short-term portfolio. It's currently up 32.2%. Can we discuss the adjustments made to the TQQ and SQQ? Absolutely. Well, I don't remember them, but we'll talk about them. TQQ is not in the short-term portfolio. Where is that? Where is that then? All right, well, anyway, so SQQ, what do we do with SQQ? We took our, I think it was a $40 call in January. We added some money to it and moved it back to the $35 call. All right, and I'll take a look in PhilStockWorld and see what it says. But let's see. Was that yesterday we made that adjustment? TQQ. Okay. That was not for a portfolio, that's why. Okay. We talked about TQQ. I like the January 87.50.75 bear put spread because they're up here, same place they were yesterday. They're up at 88. And you're just looking for a small drop. A small drop because because you're working with big numbers, you're going to get a big move. That's all there is to it. It's pretty simple. In SQQ is like, what, 30 bucks or something like that? Yeah, SQQQ is 35 bucks. So a 5% move in the NASDAQ is going to move SQQ up 15%. It's going to move TQQ, which is an ultra bullish play on the NASDAQ. It's going to move it down 15%. But 15% of 35 is like 5 bucks. 15% of 88 is 13 bucks, 14 bucks, something like that. So it's a big difference. So if you get a huge move on TQQ from very, very small move in the NASDAQ. So if your basic premise is the NASDAQ is going to fall, then it doesn't matter which one of these guys you play. They're essentially the same thing. You just have to get your head around playing the opposite side of the table. Now, there's another advantage to playing TQQ is because long-term, these ETFs tend to decay. So whether it's a long ultra ETF or a short ultra ETF, it's the constant churn that they go through to maintain their position. Like every day they're forced to buy and sell based on whatever the NASDAQ does to try to maintain sort of like 3 times ratio of the NASDAQ. And that means there's a lot of churn, and that churn costs a lot of fees. Even though it seems like a low fee, it's just a constant churning of low fees. It's just nickels and dimes your positions to death. Not your positions, but the ETF positions, but while you own the ETF, they're your positions. And all this churning by all this constant buying and selling, this is true of oil futures and all kinds of stuff, with USO, many ETFs are like this. The fact that they're constantly trying to rebalance means they're constantly buying and selling. Imagine if you took your portfolio and constantly bought and sold every day. Now, they have much lower expenses than you do when they buy and sell, but still it adds up, okay? So a lot of these ultra ETFs over time will decay over time, and they'll eventually decay to zero. No matter what this ETF does, they'll eventually go to zero. That's like 20 years from now. Over any medium period of time, though, you can always expect them to lose a little bit of ground, even if the thing it's tracking stays steady. So when you want to take a long-ish term position, like a few months, on something like TQQ, so we went out to January. So when you're going out to January, since we want SQQQ to go up, we're at a disadvantage as we go out longer because the decay is working against us. But when we're betting TQQ instead to go down, then the decay is in our favor because it's going to start losing value in what it's tracking. It's just a weird thing. But if you understand that concept, you can make much better trades because when you see an ETF and you're playing it's low, you say, maybe there's an ETF, maybe there's an opposite ETF that's high that I can use to my favor. This is more true with the triples than the doubles. But it's hardly true at all with a single. So with QQQ, there's virtually none of that, not much decay at all. With a double ETF like DXD, you'll have some decay, but not really that noticeable. But once you get into the triples, you get some really nasty decay factors. Like over time, you see it. You can watch it happen. And that's why people go crazy. They think, well, why aren't I gaining as much of my index? I have my index up 20%, and I'm only up 30% or 40%. That's because you're experiencing a lot of decay. And frankly, the more violent the moves are, the more decay you end up getting. So anyway, so in this particular case, there's a nice advantage to us in shorting TQQ rather than going long SQQ. Now, the disadvantage, though, would be I don't mind perhaps getting SQQ assigned to me at 30 bucks, and I'm going to own a bunch of SQQ at 30, but I do mind having myself put short TQQ in the 90s because, again, the same thing. The twitches, if the NASDAQ twitches 5% higher, this thing's going to pop 15%. That's like $15, so I'm not going to like that at all. So we would not take the same kind of play that we might take aggressively on an SQQ. And by the way, last year, I know we constantly went to TZA. The reason we complimented TZA last year is because it was down like 12 bucks. And so down that low, that goes back to that same logic. The logic was, if the Russell went up higher, it's back to 14 now, so it's not a big difference. But our logic on TZA last year was if the Russell went higher and tested a big number like 1,200, if the Russell went higher, I don't mind owning TZA as a short position, because I can then go and sell calls and sell more puts and do whatever and lower my basis, and I've got a nice hedge. The ownership of TZA is a nice hedge, because all I'm going to be in like next $10. So, you know, that's some of these ultras, even though they are going to decay over time, they can still be kind of an attractive thing to have in your portfolio as a direct 3-times buffer to your other positions. You know, and this is going to explain this well. All right. Let's say I'm going to use round numbers. So let's say the Russell is at 1,000, right? So 20%, so 20% up from there is going to be 1,200. Now, 20% up on the Russell, I don't know what the numbers were, but let's just pretend. So, you know, don't take this as exact. But let's say TZA was at 20. All right. So if the Russell goes up 20%, I expect TZA to drop 60%. All right. So my logic is that 60% of 20 is 14 bucks. So TZA ends up being about 6 bucks, right? So I'm going to sell the TZA $10 puts for 3 bucks as part of my TZA, you know, to pay my TZA spread. I'll take some TZA spread, doesn't matter what it is, bullish, for 3 bucks. It'll pay me like 10 bucks if TZA goes up, if the Russell went down to 800. But if it goes up to 1,200, I'm talking about a long-term position, then I know I'm going to get assigned TZA. But you know what? I'm going to get assigned. Here's my logic, though. Don't get TZA at 20, the Russell's at 1,000. And I'm saying, well, I'm going to get assigned TZA at net 7, because I collected $3 for the short put. So I'm going to get assigned at net 7, but if I'm assigned and the Russell is 6, what do I care? I'm down $1. So that's the cost of my hedge at that point. Now, if I spent the $3 on the other side of the hedge, then I'm down $4. But even if I'm down $4, all I have to do, so let's say if I was in at net 10, all I have to do is double down 6, and now I'm in TZA to 8. And now let's do some magic. So so in other words, if my net entry to TZA was 10, because I spent the $3 from the $10 put, so it doesn't really count as money I have, and I obviously lost on the bullish trade. But then I'm going to go, and now I'm going to have to, and again, it's hard because I don't have, like, you know, it's statistically not examples, but in this particular case, TZA is 14, and all I would do is take the TZA 14 and sell the January, I can sell these 12s for 5 bucks. Okay, and that's going to knock my basis down from 10 to, well, it's not 5, it's 450. Well, 490 was the last sale. So anyway, let's assume I got 5 bucks. So it would knock my basis down from 10 to 5 in the first place, just by doing that. And I'm getting called away at 12. So I wouldn't even have to do that. I could, you know, whatever TZA is out, I could sell something for $8 or $7. And knock my basis down to 3. And then I'm still hedged, so I still make 100% back on my trade if I do get called away. And yes, we just had a conversation about decay, and obviously over 2 years it will decay, but I'm only playing for the Russell to have a failure here. I don't care if I lose the net $3 by the time we get to 2016, because if I'm losing that money, it means the Russell stayed up, and that means that all my bullish bets are doing well. See, so it's all connected. You can't look at, like, one thing. And I noticed that, like, a lot of people have the thing where they feel like they have to win every single bet they make. And that's not really the right attitude. Like, if you're a general in an army and you got to land on a beach and take a bunker, you can't sit there killing. You know, realistically, you're not going to have a plan where everybody lives. Okay, but you guys will sell Private Ryan or something like that, right? They're going to kill you. They're going to kill lots of people. They might kill you. You know, if you're the general on the first landing there, you might get killed too. what you have to do is think of the bigger picture. The bigger picture, in the case of invading Normandy, is that that first wave of people has got to somehow make progress down the beach, get to a position where they can set up a spot where they can take out the bunker. Once they take out the bunker, the other guys, their success rate is going to go up like 80%, because now there's no bunker with machine guns shooting them out. Call of Duty. Yeah, I never played those games. I really would like to one day. I never really got to the new ones. I used to play the old ones, but the new versions I've never touched. But yes, I've stormed Normandy many times on my old computer games. But the point is, people are going to die. It can't be helped. And so that's same for your positions. If you're going to hedge your portfolio properly, your positions are going to die. They can't all live. And you don't, I don't want to say you don't want them to all live, but you don't plan on them all living. You have to sit there and say some of these positions are going to do badly when the market goes up. But you know what? Those are the positions that will do well when the market goes down. That's why, frankly, and I've been doing the same thing for how long now, but that's why, frankly, when we go to the short-term portfolio, and for like a month now, I keep looking at it and going, oh man, 32%. We're doing something wrong. I'm not supposed to be making 32% when the market's going up in the short-term portfolio. So it keeps freaking me out that we're under-hedged, but we have some, very smart positions. I mean, I'm not going over this game. We did it last week. There's some very, very smart positions in here that are doing very, very well. And they're market-neutral positions that will do well in almost any kind of condition. I mean, and even within our positions, we're betting against that stuff. Here I'm shorting Tesla at 275. That's not going well. Well, it's going okay. It's not going terribly. But I'm short Tesla at 275 until January, but we're long Tesla at 140. They can't both be right. Well, I'm sorry, they can both be right, because they can be between 140 and 275. But in other words, so we're long on Tesla here, and we're short on Tesla here. So, we're betting against ourselves to some extent, but we're not really. We're betting that Tesla finishes between 140 and 275. That's what the bet is. So I don't like Tesla, but I don't cheat that much, because I think it's well below 140. We have the hedge value. Besides that, I don't want to go over it all, but conceptually, you're always betting against yourself a little bit. I mean, if you do it the way we like to do it, then that's called being the house, all right? And that's the same thing, if you think about it, that's what they do at a casino, because at a casino, the guy's got, the guy's got 100 tables out there playing roulette, let's say. There's 100 roulette tables. And at the tables, he's got guys betting one color and one number and another number and another number. And so, there's bets on every number. And the casino operator wants more tables. He wants more bets, and he knows he's going to lose. It's a fact. There are going to be some people who win, and you're going to hand them the money. And you know what? They hand you the money, and they smile and go, thank you, because the person who wins is the one who gets all the other people to come and play. If there weren't any winners, nobody would come. You need winners. And it's really true for us, too. We're selling options. We're selling dreams to other people. We sell it to dumbasses who think they're so smart that they're not going to be one of the 80 to 90% of the options that expire worthless. And we sell those options to people, and we take their money, and we say, thank you very much. And once in a while, yeah, we're going to pay them. But in the grand scheme of things, we pay them a lot less than they, as an aggregate group, pay us. And so our goal is not about winning or losing. It's about making sure we're collecting our premiums on a regular basis. All right, so we talked about SQQ. So SQQ, I believe, was the $40 calls in December, and we rolled them back to the 35s in January. So let's take a look at December on SQQQ. And neither is December. There it is. All right. So the $40 calls with SQQ at 35 had fallen to about $2, and they're still about $2. And what we did is we said, let's salvage that $2 and move along to the January 35, so we paid $2 more, still the same rule, still be done. We spent $2, so we sold those guys the 40s for $2. We spent $2 more out of our pocket to roll to the 35. So what does that do? That buys us a month of time, a month more protection, and it bought us $5 worth of position for $2. That's a nice deal. All right, and how many were there? There were, I wish I knew these things off the top of my head, but there were 40 of them. So we spent 40 times 20, $8,000. So we spent $8,000 to buy another month of protection. All right, but you say another month, but we now have protection until, and we have very good protection all the way down to 35, right here where the S&P, where the NASDAQ is. So in other words, if the NASDAQ is lower than wherever it is now, whatever that number is, but if the NASDAQ is lower come January, then we know for sure the SQQ will be higher. All right? And then, so what does that do? That gives us comfort that we have 40 of these suckers. So 40 of these is $16,000. We have $16,000 worth of protection here. And that $16,000 has a cap at the moment because we still have the short 50, so that's a $15 cap. But $15 is $60,000. So we have $44,000 of upside protection that we just extended by spending $8,000. But we now have $44,000 of upside protection potential against the NASDAQ sell-off. What does that really do for us? It means that we can now go out and bravely buy more NASDAQ stuff because we're protecting ourselves against the sell-off. So protect first, then go shopping. That was the point of those trades. As the market hits a top, okay, here's our logic. We're saying the market hit 2,000. I mean, we hit 2,000. I'll get back to my active trader. All right, so there it is. The S&P hit 2,000. We don't think it's going to hold. We don't think it's going to hold. So we'll take this opportunity to press our bets. So we put $8,000 into the SQQ trade, and we put some money into DXDs as well. So we bought ourselves another like $50,000 worth of downside protection. So if we bought $50,000 more of downside protection, what does that mean? That means we can now buy $200,000 worth of position for the bullish, and we'll figure we'll lose about 25% if the market goes down. This is now protecting it. So we can now start adding another couple of $100,000 worth of position to our portfolio, and we're pretty well protected. That's what the point of this is. So before we buy, we protect ourselves. And I don't know, I mean, what is that like? I mean, it's kind of like if you're going to go in a demolition derby, right? You don't just run out in the middle of the thing without a car. You get a car, right, to protect yourself. So first you get a car, but you just get your car and drive it into a demolition derby? No, you'll be dead in 2 seconds. You have to protect yourself. So you build a crash cage, and you put on the buffers, and you put on the bumper things. All this. You do stuff to make it durable so that you can then bravely go out there and start mashing into other cars. All right, we protect ourselves first when we're about to do some buying. And then knowing that we have that protection means I've got no fear tomorrow when I go out and say, God damn it, I like this stock, and we're going to buy 10,000 shares for $50,000, you know, something like that. And it's like, great, because I know I've got downside protection. So I don't have to sit there and prevaricate and wonder and watch and whatever. I'm only protected. In fact, now I'm protected with something I know for a fact is going to lose $8,000 if the market doesn't go down. So now I need to construct a play that's going to make $8,000 if the market doesn't go down. If the market goes up, I need a play that's going to make $8,000 if the market goes up. And also because we know how to be the house, and because we're going to sell premium to other people, even if the market is flat, we know we're going to make $8,000. And even if the market goes down a little bit, we're still going to make $8,000 now along. And that's why these portfolios can do so well at the same time. Because I know for a fact in my long-term portfolio that if the market is flat or the market is up, I'm going to make a certain amount of money. That's a fact of our positions. And again, obviously your individual stock may suffer, but as we're playing a pretty good basket of decent stocks, we're generally going to go which way the market goes. So if the market is flat, we know we're going to make our money because we hedged it already. If the market's up, we know we're going to make our money because we hedged it already. If the market even goes down 10%, we're still going to make a little bit of money because we hedged it already. All right. So knowing that we're good in those positions, we should. It means why would we not spend some money on some insurance then? The insurance is against the catastrophe, and we talk about this a lot too. Is that look, our goal here is to make 20% a year consistently. And the only thing that stops us then, if you're making 20% consistently, I forget the number now, I think you have 5 times as much money in 20 years or something like that. So if we're going to make 500% over 20 years, no, it's much higher than that. I think it's 1,000%. Anyway, whatever it is, if we're going to make 10 times our money in 20 years because we're going to make 20% a year, that's our plan. What's going to mess up that plan? Well, obviously not making 20% will mess up that plan. So we try to take positions that have a very, very high probability of making 20% for us. And we also, the next most important thing though is that we hedge ourselves, because the worst thing that we can do is not make 20%, but it's not just not making 20%, losing the position. So in other words, in 20 years, if I have 4 years where I make 0, it doesn't really hurt very much. You're still going to have a huge amount of money. Okay, you're going to make 20%, 20%, 20%, 0, 20%, 20%, 0, 20%, 0. Making 0 is not going to kill you because you made your 20% so you didn't lose any money. But if you go 20%, 20%, minus 20%, then make 20%, that's a 2-year gap in which you didn't make any money. Doesn't matter, you made 20% next year. That 20% was wiped out by the other 20%. Not only that, but the 20% you lose is 20% of a bigger number than you started with. All right, so this is the point of the strategy. It's a long-term investing strategy where we're looking to build wealth over a 10 to 20-year period, 10 to 50-year period. It doesn't matter how long you go. What matters is that you've got enough time to keep rolling these trades and working it. And, those of you who started last year or this year, very lucky. We basically, especially this year, we started with new portfolios. These portfolios are going to be in play for the next 10 years. That's our plan. We're going to run these things, and we'll be able to go back. That's why we're doing these videos and everything else. We'll be able to go back anytime and say, here's what we did, here is our logic, and here's how we nurture it to be successful. Because I'm trying to figure out how to really convey how powerful this strategy is. I don't think we do a good job of it by resetting our portfolios, because when we reset our portfolios back to 0, everybody doesn't remember that we made 40% 2 years. Well, last year we didn't do well. Last year we screwed up a couple of trades because we were too aggressive. But we weren't playing this strategy last year. The year before and the year before that, we played the strategy and had 40% gain, 30% gain. So we're going back to this strategy, and we're not going to reset, and we're also not going to do that risky stuff anymore. That's our strategy this year. We're doing the thing that makes the most sense for most people. That's what we're doing now. As I've learned, this is the best strategy for people to stick to, and that's what we're trying to teach you guys. But it takes years to really get it, and don't expect to get it. I mean, I always keep saying it, but you have to actually see it happen. And once you see a few of your positions rolling over and clicking like that and making money like that, you'll start going, geez, I wish I would have done more of those kind before. And that's what we're going to do, though. We're going to keep doing this, and you're going to see just how powerful this system is. And we're always going to obviously be adding and taking away position control and so forth. There's always going to be new stuff to trade, and that, in fact, is what we're talking about today, new stuff. But from a portfolio basis, I want to just teach this strategy and keep it moving forward. It really is amazingly powerful. And you can tell from where we are now. I mean, we're up 30% in the portfolio we're supposed to be minus on, and we're up 20-something% in the other portfolio, and we still have a quarter of the year left, or a third almost. All right. So, Detmol says, SCTY, oh yeah, we closed SCTY today. That was $1,800 profit on the short-term portfolio. And yeah, it's just a typical position when we sold premium. SCTY was popping. Let me take a look at that. Where are all these things? SCTY. Oh. How do I stop that thing? It is in my ears. I don't know if you guys can hear it. That's crazy. Anyway, SCTY popped, and I don't remember when we did it, but we sold, because they popped and they got overpriced. End of story. They're not worth $75. So we bravely sold the September 77.50 calls. I think it might have been here when we did this. We sold the 77.50 call. They drift back to reality. And now see what they are, though. They're hitting that 50-day moving average. They could get a technical bounce here. That 50-day moving average has been pretty good support for these guys. So they could bounce off this 50-day moving average and go higher. But we did the math earlier in chat, and I said even if it doesn't bounce, even if those 77.50 puts at this point expire worthless, we have our protection investment in the long-term bull call spread is going to start decaying. So we're kind of betting against ourselves. In other words, the long-term bull call spread needs SCTY to go up to not lose value. But on the other hand, if SCTY goes up, then we end up paying our short caller money. We didn't want either one of those conditions, so it's time to close the trade. And that's what you have to do. You have to always evaluate these things. Thank you to whoever brought that up. I wasn't paying attention, but that was exactly the right time to close that trade was today. All right, and Pat says, we suggested to to roll the December SQQ to October 42. Are we doing that officially? Ooh, did we? We should have. You're darn right. Where'd my thing go? Monday. Today's not Monday. Oh, that's not it. That's old. Let's try that again. That's from last week's. Here we are. Get kicked on my own site. All right. Okay, so Toe had said, I currently have the QQQ 4050 as a hedge. Would you advise rolling down the 40? And I said, generally when the price of long calls is down to the price you paid, it's time to roll December 40 to still 205, January 35 to 4 with the SQQ. So I told him to do the same thing that we already did, which makes sense because it's still the right play. So, it didn't change. It's still the correct way to make the adjustment. 5 down striking to the March 35 going up. Either way, short December can be rolled to October 42 to 70. And if they hit 150, you can roll them back to January 50. Do I want to do that? I don't want to do that, and I'll tell you why. I don't want to do it because then I have to watch it. And the reality is I'm busy during the day. I don't have time to watch it. So for my own use, that is an intelligent way to play that position, but I don't have the ability to set stop, and I don't know. Sometimes I can go a whole day and not look at the portfolio, and if that happens, I can miss something important like the thing going hot on me. So I'm more comfortable not bothered. It's not important enough for me to say to change the way that's set up now. So I'll keep the December 50s and just be happy with the spread. Logically, though, you can seriously improve your position by maybe $500 by doing this, because what you're going to do is take the December 50s, which are now 80 cents. Might have changed since this morning, but they're 80 cents. You're going to roll them to the October 42, so you're going to lose a dime on the roll, but you now picked up a couple of months. So in other words, when these expire, then you'll be able to sell something else for 70 cents, and now you collected $1.40 or more when the most you could have collected before was 80. So you've increased by 60 cents the amount you collected. So if you have 10 of those, that's $600. If you have 20, it's $1,200. So it's nothing to sneeze at. All right. If you have the time to watch your account, set the stops, and pay attention, absolutely you should do that. All right. And it's an important point, by the way. Well, lots of you guys work, right? I mean, some of you guys are lawyers, some of you are doctors, right? I work. So my time's worth about $500 an hour. So for me, certain things are worth doing, certain things aren't. And this is different for everybody, though, right? It depends on what you get paid otherwise. All right? Not only that, my time, so for me to sit there and say, I'm going to watch this position or I'm going to worry about this, it's not worth me worrying about this because I could instead be making what I make today, like $500 trading these futures in one day. Not in 30 days, not in 90 days. In one day, I can make $500 trading some futures contracts if I pay attention to that instead of whether or not SQQ is going to hit my stop. So my ability to earn money in other ways then makes me make different decisions about what kind of positions I'm comfortable having. And even if it's an example for you guys, an example of portfolios, I'm physically not able to set stops and watch all these things. I know I have to play it the way I can play it. And I can play it by, because I can't sit there and put complicated stop positions in the portfolio because I'll forget and I won't get to it and so on and so forth. I can suggest, as I did this morning, a better way to play it, but that doesn't mean I'm going to play it just because I don't. But it doesn't mean go by what I do. I just have other things to do. Like right now, I'm doing this webinar. I'm not staring at the portfolios. I'm not watching my positions. Other days, I'm talking in chat to everybody and helping them with their positions. I'm not staring at my particular portfolios and watching my positions. So I prefer the long-term, no-touch conservative stuff because I'm just limited to that's what I can really do right now. I don't have time. If I'm going to day trade, I don't day trade stocks. It's too much hassle. I day trade the futures because that's fun for me. I mean, I'm very good at it and I like it. So it fits with my trading style. That's part of the thing we try to do on PhilStockWorld is we want to show you all these different ways you can trade, and you'll figure out what you're good at. Just like when you start playing baseball or football, they try you out at different positions, and you kind of fit somewhere. The coach is like, okay, well, you're good at this, so let's try to, develop that. That's what you got to do. You've got to say, I like these kind of trades, like that SCTY earnings trade, right? We do those. I'd say at least once a month or so we come up with one of those things. If those are the kind of trades that make good sense to you and you like them, then great. That's like your specialty. And everybody's going to have a different specialty with what they're comfortable with. All right? Like right now I'm staring at the futures. I'm watching this thing and thinking, oh, that's so tempting to turn right back to there. He topped out right there. But I don't have really confirmed. He's going up a little bit. He's still having trouble under 2,000. That's giving me the idea I kind of want to be short. The NASDAQ is not making it back here, so I say that this is going to be a fail. So let's bet that. Oh, I don't like when it's, that noise was going to fill too easily. I would have preferred it if it didn't fill so easily. If it fills so easily, it means sometimes you're going the wrong way. When it doesn't fill, that means you're probably on to something. Because most of these orders are fake. They're just confused by putting orders up to see if anyone bites. But they're not real. So a lot of times you put these in, especially after hours. You put this thing in, as soon as you put your order in, you see all of a sudden they jump away from where you put it. Because nobody actually intends to fill these things. It's a bunch of fake bid and ask. But anyway, so now we got one short here. And frankly, see now here, if I was able to pay attention, as long as the S&P is under 2,000, I'm comfortable that he shouldn't be making a new high. Why should he make a new high if he can't even get back to 2,000? He can't even get back to where he is, and he can't get back to where he is. All right? It's not a strong confirmation, but it's in line with what we expect at this point. Those are the kind of ways you make those trades. All right, next item. We're supposed to be looking for new trades, too. Damn, it's 1:45 already. SCTY is brought up by DMO. Yes, great. Thanks, DMO. You're very welcome, and thank you for the opening trade. Yeah. Okay, no, but those ideas, and by the way, I'll tell you guys, it's so great. It's so important to bring up trade. All right, and even if I get snarky about it, which I do sometimes, and I say it's a stupid idea, it's not working, or I say, why it's an awful idea, it doesn't mean you shouldn't have brought it up. All right, because the idea is that we're, you never know what's going to be a good trade. All right, I don't mean shocking any piece of crap, but if you feel like something's a good trade, if you heard something good about a company or something like that, let's talk about it. All right, and it's even in learning that I don't like something for some reason, it might be a good reason to find out what's wrong with it. Like today we talked about, what was it? Some analyst that's full of crap. Was it today or yesterday? Anyway, so some analyst was pumping Tesla or something like that. And I pointed out that this particular analyst is the front. They're nothing. It's an empty site. That's a very good discussion we had, by the way. So this is something that some of you guys don't think about when you're looking at things. You're not critical enough about what your source is. Like when you hear some people upgrading Tesla and some guy made some statement, and especially what ticks off me to make me look is when I read a statement and I don't agree with the statement, So I generally think I know what I'm talking about. So if I read a statement that says, oh, the Model S is going to be the greatest selling car of all time, blah, 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 and I'm like, that makes no sense. Then I don't just say that makes no sense, I don't agree. I start to think, who is this guy talking about? Global equities, right, thank you, Pat. So I say, who is global equity? And then I go, because I looked it up, and I'm like, oh, it's that son of a bitch. Because I saw the guy, as soon as I saw him, I'm like, oh, that idiot. And then I pulled up some articles and said, and I'm not the only one. There are many people who've written articles on what an idiot this guy is and how these guys are a joke. But it doesn't matter because the way the web works these days and the fact that I'm sure you guys know in all the newspapers and all the services, the news services, they cut down their staff for like nothing. So nobody checks anything anymore. Whatever comes over the PR Newswire, they slap it up as news. So this guy from Global Equities, he starts spouting off about Tesla like he knows what he's talking about. Now his price targets are $400 or whatever the hell it is. And it's all crap though. So the opportunity there, and the reason this is good to know though, is when you see that kind of stuff, that's an opportunity to short. You say, oh, Tesla's up because some moron said they're going to go to 400. So people are buying it as if he knows what he's talking about. But it doesn't mean anything. And then you know what happens? Then the Jerry comes on, and then we had a video of Kramer yesterday talking about how he manipulates the market like that. He says, Kramer is telling you, here's what we do. We get a guy like Global Equities to up his price target on the stock, and then we start buying puts on the stock, start selling puts or buying a bunch of calls on the stock, and then I have somebody place a call to somebody like Sani and tip him off that somebody's making a big buy of calls on Tesla at the same time this other guy is upgrading it, and all of a sudden it becomes a big news story on CNBC. That's how you manufacture the news. And that's how you get your stock up. And you know why he's doing all that? He's not doing all that because he wants Tesla to go up. He's doing it because he wants to dump out of Tesla, and he needs buyers to come in to take it off his hands. If it goes up, that's an accident. All he cares about is that there's a lot of buyers coming in that he can dump the stock into after it's already gone up for him. All right, that's how the game is played, guys. You gotta understand those things. So those are always points. So it's not just about a stock, whether it's good stock, bad stock, whatever. These stocks are still manipulated. It's not the stock's fault they're manipulated, but they manipulate. Apple gets manipulated constantly. It's not Apple's fault. It's Apple's fault because they refuse to respond to any kind of press inquiries, even if like the reporter from the Wall Street Journal calls and says, can you please confirm whether or not you guys are in the takeover talks or so and so? They will not comment. They refuse to comment. Now, I understand why. Steve Jobs at some point said, screw you guys, I'm busy. He said, here's our new rule. We don't talk to anybody about anything. That's what, he can do that. He's Steve Jobs. Now it's still their policy, though. And the problem is because if that's your policy, then people take advantage of your policy and start rumors about your company that they know aren't going to get to know. And, with other companies, lack of denial means probably right. And so people start assuming that even though it's Apple, they won't see the difference between the way Apple acts and the way other people act. It's all crazy. There's so many different variables. It's very funny. But, the thing is, as you get better at one thing, you start learning another thing. You learn more and more tricks as time goes by. How are we doing? 19985 for a 70. If 470 breaks, I'll be very happy. 17, obviously 17-1 breaks too, I'll be happy. My one little put there, though, so it's no big deal. Decmal says, I sold 140 naked calls on GMCR, bought a spread to cover. I know it's risky with all the news. I have 3 months to sell by. It's worked great this year. GMCR, Twitter, Yeah, well, we love that kind of trade. The idea is you're covering the 145, 155. You're selling the 140s. And your worst case is you're going to roll them if GMCR, is it over 140 now? Where is it? It's 136 now. So if it does pop, you're going to be able to roll. You're not going to like it, but you know you can. And if it doesn't pop, your October short call is going to expire naked, and you'll be able to sell the spread for whatever is left. It's a great way to trade, but it can get messy sometimes. Once you're comfortable unwinding them, that's when you're going to start liking a lot more. Mike says also people don't keep perspective. Oh, people in general. The Apple call should always be next to the Tesla call for perspective. Yeah, that's true. That was the point I was making. Like I said, this guy's such an idiot. He made this incredibly horrible Apple call that showed he has no concept of what he's talking about. He's not even specializing in cars. He doesn't know anything about cars. He's a tech guy. I mean, seriously, you got a guy who thinks well, he's theoretically a tech guy. He's supposedly a tech analyst, but he's talking about Tesla. You know, knowing about tech doesn't mean, knowing about the dashboard of a car doesn't mean you can talk about the entire car's operation. All right, next. Where were we? We were going to buy stuff. That's right. How do we get on these tangents? All right, long-term portfolio. So long-term, and please keep in mind, this guy's up 32%. That sounds really impressive to be up 32%, but it's only $100,000. He's up 22% with $500,000. That is so much more impressive. All right, this is where the money is. The other portfolio is for fun and protection. This one is for the investments. In other words, that's another thing about the short-term portfolio, because the ratio is 5 to 1. Long-term 5, short-term 1. If our long-term portfolio is on track and makes it 20%, even if the short-term portfolio is completely wiped out, so they only allocated $100,000 to it, even if it's completely wiped out, you still have a 0 year. And we don't want to have a 0 year, but the point is, even if a catastrophe strikes a short-term portfolio, you're still going to be able to survive the year and move on. And why would the short-term, and again, why would the short-term portfolio be at 0? Because the market went incredibly bullish and shot up. That could happen. All right, because if you have the wrong kind of bearish place. We try not to do that, obviously, but it can happen. Do we think Duncan might be in play, given the silly deal on the other? That's interesting. Let's take a look at Duncan. Hopefully this thing won't ring my ears again. DNKN. Let's see. Well, they've come down a bit. Now, the question is, come down to what, from what, and what's their value now, and what are they worth? But I like it, so let's pursue this one. DNKN. P32, 4P21. So, donut burger. Oh, that's gross. God. Please make it stop. I like Dunkin' Donuts because they have Baskin-Robbins too, and I also like the fact that Baskin-Robbins just started showing up in the supermarkets. But it's too expensive. The way they're doing it is too expensive in the packaging of it. But that's just my consumer packaging opinion on it. But to me, if you pick it up, it's lighter than Ben Jerry's. Like, if you feel it, doesn't feel as substantial. It's in a smaller thing. I think it's like 11 ounces, not 12 or whatever the hell. And it's not cheaper. If it were cheaper, that would be great. It's not. And they don't do the big ones. They only do small ones. So several problems with it, but I still think getting it out in supermarkets is a very smart idea. There's certainly plenty of people like Dunkin' Donuts, especially compared to like Breyers or something like that they have in store. I'm not Dunkin' Donuts, Baskin-Robbins. Anyhow, so what do I want to say? I want to see the income statement. And as you can see, not very much on top line growth, but little. They just did a good job here cutting costs, but then they didn't grow. So they got to start thinking on a quarterly basis. 183, 83, so 190 seems to be moving along. Well, that's weird. Why did one say December 28th and also December 29th? So it looks like, and bottom line drops. This was a problem, but we assume it was just some aberrant thing that happened to them. So 45 million a quarter is not bad. Balance sheet, I doubt they had a lot of debt. No, they had more debt than I thought. $1.8 billion of debt. Now, always remember this when you look at the balance sheet. The annual doesn't mean anything. What matters is what the last quarterly statement. All right, so their debt is still $1.8 billion. Their cash is $200 million. Their intangible assets are are BS, basically. Goodwill is even more BS than intangible. So most of their assets are bullshit. It's not a pretty picture from that perspective. I'll take a look at their cash flow and see how they do. Cash flow wise, they're paying a little dividend, they're buying back their own stock, they're borrowing money to pay their dividend, buy back their stock. I don't like that. That pisses me off. Dropping a little bit of cash to the bottom line, but not much. And see, that's what I mean by getting the right picture, right? Look at the annual, right? See your annual cash flow looks okay. But if you go to the quarterly, you can see why the stock's been dropping. Look at that. They burned up a lot of cash. And what do they do it by, though? They did a huge buyback. They spent a lot of money buying back their own stock. They're paying these dividends. Now, when you see this, by the way, when the cash flow goes negative and they're paying a dividend, it's possible to cut the dividend, and any company that cuts the dividend usually has people running. So for those reasons, and again, it's just a quick examination. I'm not spending like an hour looking at it. But as those quick notes go, I would probably not be too enthusiastic about getting into them until I actually see how they're achieving this forward PE of 21. I need to read and get more comfortable with this company to see how they're going to get into 21 from 32. But I think they're probably doing it. I think they're mostly doing it by buying back their own stock. They're only a $4.5 million company. They're not big. Then you want to take also, if you want to look at it, I want to know how many stores they have, and you tell here. So they've got, wow, 7,300. Are you kidding me? 11,000 and 7,300. That's pretty impressive. That doesn't mean it's good. It just means it's a lot. Let me look at THI. And they only had, look at 4,000 restaurants, including 3,000. So they got 4,500 compared to 12,000. They're one-third the size of Dunkin'. Yet they're getting bought for twice the price. So, I mean, I agree, Mike, that you have a, I'm sorry, Mike? Yeah. I agree, Mike, that you had a good idea about that because, well, realistically, they're no worse. Dunkin' is not worse than THI in any way. I mean, they're worth the same. These guys are worth the same. Dunkin' is probably better than THI, but THI got bought. And I think it's probably because if Burger King went to Baskin Robbins, they wouldn't have been so enthusiastic about getting bought as THI. THI, the difference to go to Burger King, it's real. They got 4,000 stores, right? THI? Let's go back to that profile. They got 4,500 stores. Now watch what BKW does to them. Sorry, I should do it here. BKW has 7,300 franchise restaurants. Wait. In the U.S. and Canada, there you go. 10,000. So it's 10,000. So 7, 10, 12, 13. So somewhere around 13,000 restaurants. So for Horton, they are going to be able to get into 13,000 new places. That's really cool. Oh, please don't tell me I get screwed on TF. Well, thank you for saying so. It was important for me to know. Did I not get out of that? I didn't get out. Stupid. All right. Oh, look at that nasty spike. That's okay. Now, I'm at 1172.80. If I'm looking to say if it doubled down, I think this is a pointless spike. It's 2 o'clock. I don't know why 2 o'clock wouldn't exist. I want to watch him as long as he's going to fail here. If he fails, I'm still into this. 1174, I'm going to go for it. I'm going to hit 1. That's going to bring my average up to 1173.40. Now I'm going to take this seriously because the next one, if I'm going to double down again, where would I double down again? I want to get up to 1174. So that's 6 down. So at 11,740.60, I would like to get one more. No, I'm sorry, I want to get 2 more. And that would bring my average up to 1174, and then I would bail if we go past 1175. But since this red line is at 1175.80, I might want to wait a little bit longer just in case. I'm not going to be so quick till I jump on that. Unless 2,000 breaks to the upside, I still like being short here. All right, so I'm still kind of into that short. These do not look good, though. Everybody's heading up now. Is the dollar dropping? Has anyone seen that? The dollar is rising. Wow. Dollar, I mean, not rising at this moment. The dollar is up. So we'll see. But the they, you know, the quote theys, they're certainly going to want to try to get a close of the S&P above 2,000. If they fail it, though, see, here's my thing. I don't think there's a lot of upside risk here. I think 1175 is probably the top. So I'm not too worried about losing a couple of $100. The possibility, though, that we fail to hold 2,000 and people start losing confidence and the thing pulls back to yesterday's levels, that would make me $1,000 right here. This line is worth well. With 2, it's worth $2,000 as well. So I have a chance of losing a few $100 up here, but I have a chance of making $2,000 down here. I like those chances. So I'm willing to press that bet a little bit. Where are we? Okay, still short TF, right? And thanks for pointing that out, Sean. TZ insurance getting tempting again. Well, it's always tempting. I mean, you know, but I really wouldn't want to add anything. I think we're short enough as far as EXD and the TQQ and the SQQ. I think that's plenty short. Especially because we're kind of really, we're short of the NASDAQ, but Apple is going to top out around 105, and then Apple will pull back and retrace a little bit, and that's going to pull the whole NASDAQ back to whatever reason. You know, if the Apple phone is great and they release it and everyone thinks it's fantastic and so on and so forth, it's probably going to keep them up around 105, but it's not going to make them go to 130 or anything like that. But if there's any disappointment at all in the Apple product, they're going to go back down to like 90, you know, probably at least 95, probably 90. So, you know, that's worth playing for. For a correction like that, Apple 10% is going to knock the S&P, knock the whole NASDAQ down 2 to 3%, no matter what. Probably 5% though, if the Apple corrects 10%. So I like those as our medium-term hedges. If the NASDAQ, I'm sorry, if the Russell goes back to 1,200, I'm going to like TZA a lot by that. But at the moment, I'm sort of in between. It could easily go up or down 25 points. So here's that 2,000 line. I'm going to want to see some failure here. And meanwhile, let's move along. So I'm not going to keep staring back. I'm just going to take my lumps if I have to. Let's see. Buy list. Okay. So we have our buy list, and this is all under the virtual portfolio tab that we have on the main page, right? So that's, well, I got to move the chat box. So here we have this tab, and it has all these different things, and it's got the buy list. What it also has, though, and this is more important to discuss in a moment, is we've got we have the old long-term portfolio. And that's what I wanted to talk about today. We're running long, but I'll still get to it. It's okay. The buy list and the long-term portfolio. Oh, no, that's not the right one. There it is. Okay. All right, so from the long-term portfolio, here's the trick now. And how am I going to reconcile these two things? Here's what I want to do. And we're not going to, I guess we won't do them all, but because we just went over that one, whatever the hell I was just looking at, Dunkin' Donuts. So I just went over Dunkin' Donuts, and somebody said that was useful to hear me thinking about it, which is, you know, it is good to talk out loud. Sometimes I try to type out my thoughts out loud, but, you know, kind of pain in the ass. So I'm just typing, like, to me, it's random stuff. I mean, I know it's not random stuff, but for those of you who don't think that way, it's kind of good to watch what I'm saying. So I try, sometimes when I'm in the mood and when I have time, I'll tend to put a longer explanation down on why I'm getting into something or not. The whole purpose of the buy list, though, all right, let's see, Exhibit A, the buy list. Get it out here. So the purpose of the buy list is to have those long-term thoughts down on paper. Broadcom, I like to buy it. Here's why. Here's what we like to trade, so on and so forth. CJJ is down with uranium, blah, blah, blah. Okay. Now, the most useful thing about the buy list is that when you go to the buy list, all these charts update. So they're going to show you currently where they stand. And since we like all the stocks in the buy list, the ones that are low are good ones to buy. This is not complicated. So you just go to the buy list, you look for ones that are good to buy, and like here, Canadian, took a nice dip, good to buy. iRobot, still pretty cheap. JDSU, I just banged my foot on that one a couple of days ago, and it's just kind of, there's one I would add right now. JDSU, right here. Not complicated, this is a trade. Man, so many of these things have gotten away already. Pfizer, still a good deal, pays a nice dividend. RIG, we've been banging the table on RIG as it's been down here for 1 month. The entire month of August, we've been saying RIG. This is fantastic pricing for these guys. RR Donnelly took off, Taser took off, Tex took off, geez. Wendy's still not bad. It's getting up there, though. So that bargain's going away. I've been banging on Wendy's all week. Now, Wendy's used to own THI, poor guys. I don't think all of Wendy's is, let me think. I'm pretty sure Wendy's itself is not worth $10 billion now. WEN. No, $3 billion. Holy cow, they spun THI off. They didn't get anything for it. They barely got anything for it. That's sad. I wonder if they ever held any stocks. Nobody's mentioned that. Where were we? Buy list, right? Anyway, all right, so Wendy's is good and Whole Foods is good too. Whole Foods, I'm telling people to get back into too. So all these, now notice all these things, everything. So what's our quote system? Our system is that we look at the buy list and we say, who's still cheap today? Today's the day we want to buy some stocks. Who's still cheap? That's not complicated. You can do this anytime you want. Whenever you're scanning, buy some stocks. So to that end, what I'm going to do, and we're not going to do it, so I'm just going to tell you, we went through this valuation thing on Duncan, but just to give you an idea, we're going to go to the old long-term portfolio. We're going to see who isn't in the buy list. And just because you weren't in the buy list doesn't mean you should be in the buy list. There's several steps to this process. Apple, not in the buy list. Why is it not on the buy list? Because it's not cheap. And why is it still not going to be in the buy list? It's still not cheap. Okay, the reason things go on the buy list is because at the moment that I include them, they're good deals. ABX, already in the buy list. Broadcom, not in the buy list, but probably not cheap. Let me see. BRCM. So the step one to my process is saying who is not in the buy list and who is cheap. But all these stocks, in other words, the thing about these long-term positions is they've already been vetted by us. They're already positions that we know we like. So if I'm looking for things where I say, ooh, what do I have from those guys? So here's BTU, Kate, Caterpillar, Cliff is in the buy list, right? DVA. Oh, DVA got cheap again. Here's Deere, eBay, Eagle. Eagle we already have in our portfolio. See, we forget that we already made $1,000 on these guys. eBay, what did I say? SCX we were just talking about today. GLL, that's another one. I was a play on gold long, that worked out. Halcyon, we got Canadian, Intel, iRobot, we just mentioned. Lionsgate Film, we've got all about those guys. We haven't played them in ages. How they do? I think they're doing good because they came out after they had that disappointing thing. They had a good one. Yeah. So they're kind of so-so. Probably not good enough to go in because they're not cheap enough. Lulu, Microsoft, NLY, who love the dividends. Transocean, of course, always in our list. Basically, whenever you can buy Transocean, cheap to buy. RRD is on the buy list now. Sears, we kind of lost interest. See, there's one that would take an hour of my time at least to look over. I like Sears. I like Sears because I think the real estate play on Sears is good. I think Eddie Lampert knows what he's doing. I think that he's currently driving the price down to shake out whoever he can so that he can then buy more stock. That's what I think he's doing right now. You know, he's not going to announce his big real estate play until he has a chance to chase out all the people who he might be able to get for cheap. Silver we like, SPY, but we do long on SPY. AT&T, Taser, AT&T also with great dividend. Taser and Twitter. Twitter has certainly got hold of me. So there's 20 more stocks, or 19 stocks, I think. There's 19 stocks that also, and maybe 12 of them are not on the buy list already, that we need to take a very close look at over the weekend. I'm going to add them to the buy list, I think. I want to make another buy list. I want to add to the same buy list, okay? Anybody reject that? I think that's a good idea. It's like, let's have one buy list, not like 10, even though it's going to have like 40 things on it. And I'm going to try to add, I think we have 29 things on it now. I'd like to get at least 11 new things on it. We'll make it even 40. And so we'll add, and honestly, if you have 40 things and none of them are down, then your market's overbought. So I think if we have 40 things and there's nothing to buy, it's certainly time to cash out. That's my attitude. All right, so let's get back up here and see if I can catch up on some questions. All right, selling. All right, TCA. Oh, how do we do on my broke yet? No, it's 1174. Okay. So, 1174. Wait a minute. What the hell is my average? Oh no, that's okay. All right, TZA. So Deckmal said selling on TZA puts. Again, I'm not that into it right now. I don't know. Let me check on the pricing. TZA. It's not my first choice now. As I said, if the Russell hits 1200, I'm all into it. So it's still good though. I'm looking still the $13 put for 280. That's not bad. It's a pretty damn low net entry, $10. But you know, if the Russell goes up 10%, this is going to drop 30%. You're going to be close to that $10. All right, so 10% move up in the Russell of 120 points, so 120 points up from where it is now, is going to take you to 1170 and 90 and 1290. So if the Russell pops to 1300, that's the point at which you'll be assigned those puts. Now, that's not bad. I don't think that's a terrible thing. If you really want to make a move now, that's not a bad move to make. But again, I don't see the need for it based on what we already have. But absolutely, if the Russell goes to 1200, and those I would then sell maybe the $12 puts and hopefully get $3 for those. That means to a net 9 entry, and then you pair that. And I say, okay, I don't mind owning this thing for $9. Therefore, because $9 is what? It's 1300 on the Russell. So even if the Russell's at 1300, I still don't mind owning these 9s. That's not a problem for me. You know, long term, I don't mind that being a buffer in my portfolio against the hedge. Now, since they're at 14, though, what am I going to do? I'm going to take that $3 I collect here, and I'm going to say, what can I get for $3? And I say, okay, so we're going to take the, let's say the 13s. All right. Now I'll go for these. The 14s are let's call that $4. So it's $4 for the 14s, and I can go all the way to the 20s for $2.75 in between the two. That's $1. That's only $1.25. So for $1.25 each, I can have that, right? It's crazy. For $1.25, I can have the 14-20 all call spread, $6 in protection. Now, each one of these I sell for $3, buys me 2 of those, and I still have money left. All right, so I can take. So let's say theoretically, if I sold 10 of the $12 puts for $3, they're not 3 now. I'm thinking of a drop. I sold 10 of these puts for $3. Then I can buy 30 of the longs for $1.20 each. So for very little money, for 60 cents or 20 cents per contract, I'm going to have $6 upside protection and 30 contracts times, what did I say, 13 to 20 or total 14 points. So $30 times 6 is $18,000. So I get $18,000 worth of protection in exchange for my agreement to buy $9,000 worth of TZA. That's fair. Because you know what? If TZA actually goes all the way down to 9, I end up owning $9,000 TZA. And like I said, if I own TZA for 9 and I then turn around and I sell the, well, it wouldn't be this price, but let's say I sell the $9 calls for $4. Now my net on TZA is 5, and I get called away at 9. So then if the Russell stays flat in 1,300, I hope I'm not getting too far ahead. It's like chess if you try to explain the next 5 moves. It gets really complicated. But you know, if the Russell's at 1,300 and TZA is at 9, and I sell the TZA $10 calls for $4, you know, in a year or so out, 2 years out, then I've knocked my basis down to $5, and I get called away 10 with 100% gain. And if not, my basis is only $5. What do I give a damn? You know, then I only spent $5,000. But what does this $5,000 do? The only way I lose that $5,000 is because the market stays up for another year. And if the market stays up for another year, I'm sure it's probably going to make a lot more than $5,000 on my loss. That's what this is all about. It's like you have to just think about all the repercussions and how it all fits together. And that's how you get comfortable with these things. That's why you sit there and say, oh, I lost money. Like, you know, the short-term portfolio is losing money. And again, something is in a weird place right now. But usually, if the short-term portfolio is losing money, I'm happy because I know I'm making a lot of money in my long-term portfolio. I want my short-term portfolio to lose money. It's bearish. All right? By accident, we've made a lot of really smart plays in the short-term portfolio, and it wins anyway. But generally, the idea is the short-term portfolio is bearish and loses money while the long-term portfolio. And by the way, that was working perfectly at the beginning of the year. The short-term portfolio was down about 10% earlier in the year. Now it's up 30%, had a hell of a turnaround. But it wasn't because of our hedges. Our hedges never paid off. In fact, despite the fact that we've lost tens of thousands of dollars on the hedges, we just keep making money in the positions. You know, and it's cute things like that, SCTY and stuff like that. We just took SCTY off the short-term portfolio today. It's a little thing here. It's 2,000 here and 3,000 there and 1,000 there. You just make a little bit of money here and there, and it pays for everything else. That's all. All right, so Mike says, just bought the following recently, PEX, ADB, slow money. Yes, slow money is the kind of money we like to make. You know, when you have $500,000 on the table, you don't want to make fast money because that's how you lose. You know, if you can win fast, you can lose fast. If you're winning slow, you're only going to lose slow. And when you lose slow, you can adjust. When you lose fast, you can't adjust. Money's gone. WFM, can you overview quickly the fundamental rationale? If no time, no worries. Yeah, on Whole Foods, it's about, first of all, they're moving into Europe. Second of all, they're like Best Buy today. Best Buy is another good example. Best Buy had a bad quarter, but they had a bad quarter because everybody in electronics had a bad quarter. Consumer spending was down, and malls had a bad quarter. Everyone had a bad quarter. So why should they have had a good quarter? It cracks me up because people will sell a stock off for doing nothing wrong, for being a stock. It's like, oh, I had a company in America. You know, essentially what Best Buy said is, okay, it's like, well, we had a company in America, and we were selling electronics, which were probably the worst performing sector in America at the time. That's why we didn't have a good quarter. Why would you punish the stock for that? It doesn't change their business. It doesn't change their model. It doesn't change their strategy. They don't have cash issues. They're in perfectly good shape. And in fact, frankly, they did very well considering how crappy everything has been. But the stock went down like 5% today. Let me see what it is. Yeah, $2. That's crazy. It's more than 5% now, right? It's 7%. So, you know, this is the kind of stuff you want to act on if it's on your list. Now, Best Buy's not on our list because when it was on our list, it was like $5, and we got out of it since then. You know, it's like now it's back to a regular price. But it's going to get a little bit more attracted to us if it gets down to like 25 or something like that. We're kind of excited about it. Whole Foods. This is how I answer Whole Foods with Best Buy lecture. Whole Foods, also same thing. What benefited Whole Foods early in the year was that they get a substantial amount of their groceries from, and I mean groceries like, you know, fresh produce and stuff. They get a substantial amount of their produce from local farms. And so the local farmers don't have a lot of pricing power. Whole Foods makes deals with them. And not that Whole Foods is muffling around, frankly. They actually are very generous with their local people. But Whole Foods, they make contracts with them And they don't, the thing that Whole Foods does do that's a little uncomfortable for the farmer, they don't change the price. So if the farmer has a bad year, he can't raise the price. He can't say, oh, you know, I thought I was going to have, 1,000 bushels of apples, but I only have 800 bushels of apples, but my apples still cost the same to grow. It's just a tough season, therefore I'm raising the price of apples. That's how it works. That's how the commodity market works. Commodity market's like, sorry, we only have this much, and we're going to have to charge you more to get it because we want to make our price. That's not what the Whole Foods guys do. But on the other hand, the same inflexible contract, when the farm has produced 1,200 bushels, which is what's happening with corn right now, there's a flood of corn on the market. The farmers who sell to Whole Foods with the local contracts have very fixed prices, and Whole Foods is not benefiting from the savings. Therefore, in comparison to other local markets, their prices have crept up. What was really benefiting them earlier in the year is that other markets were getting so expensive, and DBA shot up to crazy prices earlier this year, which caused us to get out of it early because we didn't expect it to go up that high. And we were right because it went down after that. But when DBA shot up and all the agricultural products shot up earlier in the year, Whole Foods was looking good because they had their locked-in prices, and it didn't matter to them that everything else, the commodities, was going crazy. And people were actually starting to go, hey, this isn't really much more expensive than my local supermarket, and the food's much better. You know, so people were starting to realize that Whole Foods had something going on. Unfortunately, though, people are very, very, especially the new shoppers that came in, they're very price conscious. And what happens is, as the food prices went down, Whole Foods doesn't drop their prices to match it. I went to Fairway, and Fairway has 4 corn for $1. 4 years of corn for $1. That's crazy. Okay, I mean, you know, I'm not scrounging, thank goodness. But I mean, if your family isn't that rich and you want to save some money, I'd be having corn like every other day with the kids. I'd be like their main vegetable this year. So, you know, that avocados are crazy cheap. I got 5 avocados for $5. I mean, you know, I love avocados. I was like, you know, I had to buy. She said, "Why did you buy 5 avocados?" I'm like, they were $1. How did you not buy 5? When they're 5 for, you know, with $5 to $5. It's crazy. Because usually I buy 1 or 2 because they're usually 2 for $5. You know, so that's the thing though. So I go to Fairway, and I go to both places. I go to Whole Foods all the time, but I also go to Fairway to buy most of my stuff because they're much cheaper generally. Now they've gotten much, much cheaper. So now it's like I don't even look at the prices. I don't even go to that aisle in Whole Foods anymore. I don't go to the produce section right now because they're so out of sync with where the rest of things are. And that's hurting their business. So anyway, this too shall pass. These are just cycles. It has nothing to do with their business. It has nothing to do with their operation. And frankly, by the time they roll their contracts over, they're going to make adjustments because they know they made a mistake. All right? Also, Whole Foods is expanding in Europe. Europe is the worst place on earth right now, but Whole Foods is expanding there. That's okay, though. So still, it's fine. They're going to do great. It's going to just be time. And when Europe comes back, all of a sudden Whole Foods is going to explode, and everyone's going to go, who would have known the Whole Foods suddenly had all this potential? But they will. So now, you know, buy them when they're cheap. Don't buy them when they're expensive. Sears is burning cash big time. Yes, they are. But my theory on Sears very quickly is that Sears is a this is my theory of Sears from like 5 years ago when Lamper first got involved or whenever it was, is that Sears, he can't break it up. He can't start selling off the stores and closing stores and firing thousands of people until he wrecks it. He doesn't want to be hated for destroying an American icon. What he wants to do is be loved for trying to save it and then to make a fortune selling off the pieces. If you think about the assets of Sears, the real estate assets of Sears are severely undervalued. If you, you know, I don't think I have to explain it to you. Anybody who knows the Sears, if you think of 5 Sears stores that you know, they're generally either key locations in a mall, like anchor stores in a mall, or they are like central big things in the middle of your town. Like, you know, one of the best spots in town is like the Sears from like 100 years ago. They've got incredible land all over America. Some of those malls, they own the actual, you know, sometimes they own the mall, sometimes they built the space in the mall. But they were like, you know, they were there when the things were built, Sears. They were the big store for a lot of people. And They got a bunch of brands that they can sell off. They got all kinds of things. You break that company up, you'll get some real cash out of it. But you can't lose money at the rate he's losing it. That's the problem. You can't keep losing money like this. So I kind of want to see him stop burning so much cash, because I don't see the end game for that. I mean, you know, even if you say, oh, they're really worth $20 billion, not $4 billion. That's great, but if you're going to burn $8 billion a year in losses, then it doesn't matter that you could be so. It doesn't matter you have $20 billion in assets anymore. It's not the point. So we'll have to wait and see. But I do think that he's going to probably pull this thing out. I think he's actually purposely tanking the stock at the moment so that he can get in his house and buy it all up and buy it, you know, just before the big sell-off. Beckmo says TZA. I bought the calls offset by the put. Sure, perfectly great play. I mean, especially if you don't mind owning it, it's a free play basically. FWM. Oh, that's Fairway. No, I don't like Fairway though. I said now Fairway. I like Fairway shopping there, but I wouldn't buy it. It's like a grocery store, but they have a higher overhead. They don't really see the thing about Whole Foods is Whole Foods attracts people like me who have generally no idea what things cost and don't really care. And I just sort of like, I mean, every time I go there and I buy stuff, it's like $200. I'm like, holy crap, $200 really? But I still go back. So it's like, I like the food. You know, I don't care. And also I realize this is my Tina cares, my wife cares. But I said to her before, I'm like, you know what, if I go to A&P, it's $150. And I said the bottom line for me is I like Whole Foods $50 better than I like A&P. So I'm happy to give them the $50. You know, that's because I don't care about $50. But if people care, but most people care about $50, and they're not going to go to Whole Foods. They're not going to. And Fairway though has, you know, so Whole Foods is for people like me, and they've got plenty of customers because there's plenty of people like you, plenty of people in the top 10% who don't care whether it's $50 cheaper or not. And would rather have the higher quality foods. As to Fairway though, Fairway is kind of catering to the regular people. They're not really, don't have that high-end cachet. They don't sell this stuff. I see people there all the time, and they're regular shoppers. They're the same people who are in the shop right in the A&P like that also. And they just kind of, you know, I do the same thing. Even though I got money, so I still have my favorite stuff in different stores. So I'll go to like, sometimes I go to Whole Foods, sometimes I go to Fairway, and once in a while I go to A&P. I don't generally like A&P myself. I hate Shopper. I wouldn't set foot in. So the point being, though, that Whole Foods, Fairway, from my observation, does not have the high-end customers, and therefore they're really competing directly with A&P and ShopRite, and they don't have more customers than ShopRite that I see, and they don't have, but they have a bigger store and a fancier store, and it's sort of like they're what my mom says is putting on airs. They're acting like a fancy store, but they're not a fancy store, and they're not attracting the kind of people who spend the kind of money that a fancy store would get, which is bad for them for margins. And in addition to that, they're putting a lot of cash in trying to expand and open up new stores. And again, that's a problem because they're moving. You know, they used to be in New York, and in New York you can charge a fortune for your stuff. You can't do that in Jersey. There's 5 other supermarkets. You know, so they started in New York, where there was only 2 supermarkets to go to. You can go this one or that one. And so they have plenty of people, and in New York there's plenty of rich people who don't care about $50. So they hit to get their markups. In Jersey, they ain't getting their $50. Whole Foods can get their $50 because they're walking the walk and talking the talk. You know, they're putting out the stuff that makes people who have the extra $50 want to come in. I don't see Whole Foods doing that, so I think they got some problems. So I hope they don't die. I think that, but I wouldn't buy them as a stock. Dieter has not caught on to the idea of chatting to all participants because if see someone asks about HP, I think the stock is too expensive at this stage. Do we get into HP? I said we got to look at it closely. I like them. I like them a lot. I think they're worth more than they are now, but not necessarily a bargain. Decmo says Hub is on the buy list and it's low on the price channel. If we don't have it, buy. Yes, I do like Hub Canadian, especially if we can make an options play out of it. All right, so let's take a look. And water. 2 hours and a half, I need water. All right, where was I? 419. Okay, well that's not bad. But it's always a question, what can you sell? So at $4.19, I can buy the stock. Oh, geez, of course I'm going to do this. Look at it. You buy the stock, you sell the $4 put for 70 cents. I would definitely want 75 there at least. I think you can probably get 80. So I would start this trade off by asking to 80. That would be my first step. So step one is offer to sell these to 80 $4 puts. Step two would be buying the stock and then selling this cover for, it's $1.10 last thing. So I try to get $1.15 if I could, but $1.10 fall. If I get my 80, I'll be happy. If I get 80, I sell those for $1.10. That's $1.90 off your $4.19, right? So your net is, let's say it's $4.20. So your net is $3.40, $2.40. So you're netting into $2.40 with a call away of $4 on that trade. If you have another round assigned to you at $4 and your average cost is $6.40 divided by 2 is $3.20. So your average cost would be $1 lower than the current price if it's assigned to you below $4. And if you get called away at $4, you're going to make $1.60 off the $2.40 entry, which is, that should be easy to calculate. It's like 60% or something like that. So that's the way to go. $1.40, yeah, okay. So Pubnavian, absolutely. I mean, when you have options that are that, see, the thing is the volatility of Pubnavian causes the options to have these great premiums, and that's how we can take advantage of it. All right, you don't need to own the stock. You could instead, you could buy the 3s or the 350s. Okay, you buy the 350s for like $1.35. Well, it says $1.18 there, but I doubt it. Let's say $1.30, and then you can sell these guys for like 80 cents sounds reasonable. So $1.30 minus 80 is 50 cents. So you'd have the $3.50 $5 spread, $1.50 spread 50 cents, and then you can just sell the $3.50 puts for 45 cents, and you'd have a nickel on $1.50 spread. So instead of trying to make $1.60 with your buy right, you could do an artificial that does the same thing. Frankly, though, it makes no difference. The net, when you do it either way, comes out about the same. All right, so your net would be 360. If you have 2x, the only difference is, though, by doing an artificial, you can keep it down to 1x. All right, and there's also advantages to owning stock because if you own the stock, then when it comes down to January 2015, you're just going to do a roll of the short call, or you're not going to have to cash out the whole position. Not that that's a big deal. But for a continuity basis, if your goal is to long-term accumulate a lot of what may be an actual stock in the hopes of getting dividends and so on down the road, then obviously you're going to own the stock. And it's not really expensive enough where I want to avoid owning it. If it's Apple, it's a whole different ballgame. So why should I take? Well, not anymore. That was $100. But when Apple was $700, I kept telling people, like, why do you want to own the stock? Why do you want to tie up $500 when you can buy a bull call spread for $50? It makes no sense. When you're saving that much, it makes no sense. Here, you're only saving yourself $1.50 of cash, so it's not really worth the effort. Is there any country where GSK has the right people? That would be an interesting map. They should do one of the infographics. Do they have to be convicted, or is it just? Okay, where are we now? Hang on, oops, I lost track here. We're on the buy list. 25 stuff for the Saints. Oh yeah. Hey, Mike, that's true. I discovered that. There's a place called Corrados in Clifton. I mean, obviously not too many others in Jersey, but it's a Spanish part of town, not too far from here, about 10 miles from the rural Spanish area. And there's a market called Corrados, and I think Corrados is actually Italian, but basically everybody in there is Spanish. And I guess it's Italian from the old days when they used to be mostly Italians up here. But anyway, somebody told me they had really great oranges. I love oranges, so I was like, if I was pitching, I couldn't get any good oranges. So for $10 freaking, this is the only bad thing about it, $10, I got a half a gallon of oranges. It was as good as anything I get in Florida, though. It's fantastic. So I am going to go back and get the orange juice. But the price is outrageous. My mom buys the same kind of stuff for like $3. But point being, though, I was dumbfounded by how cheap everything in that store was. Not, you know, all the produce was half price from what I usually pay. Most of the dry goods and things were cheaper, like 10%, 15% cheaper than what I would usually pay. I could not believe it. And I sat there and go to myself like, wow, this is how poor people can afford to live. It's just, it is amazing what would, you know, if you shop around and you actually try hard to save money and you have coupons and crap like that, you can really do pretty well in some of these places. It's very odd, though. We're 10 miles away from where I am, and there's nobody that I know. Well, obviously somebody I know that's very home to go there, but not many people I know go there. And but it was packed. I mean, it was absolutely packed. In fact, I tell you what I noticed though, there were chefs buying food there. There were guys from restaurants buying their food there because it's cheaper. That's how you know it's a good place. So yeah, these things are really incredible. 5 avocados for $2. You know, I'd be making guacamole every night. But, you know, as with anything else, you got to find the bargain. But then it goes back to, is it worth my time to go there? That was actually, you know, 20 minutes out of my way to go get some orange juice. So I love fresh orange juice like that, so I would do it once in a while, but it's still a treat. It's not about $10. If Fairway had the same thing for $10, I'd buy it every week. But it's just my time is worth too much to bother doing something like that. So GSK, anytime on Galaxa. Yeah, we're going to go over that. So please do me a favor in chat, remind me. And anybody who has suggestions, please put them in chat. And I'm going to start this week adding those 11 stocks. I'm going to try to pick 11 new stocks for the buy list. So I'm going to go by, obviously, what we looked at in the old long-term portfolio, but I also want to look at things that you guys suggest. So Hog was a great suggestion. If the right price, it's going to go on the list of what I think is already in there. GSK, I don't know if they're cheap or not. I'll take a look later, though, because we've got to wrap this up. And let's see, Mike says, good dividend, or maybe cancel pipeline. Yeah, pipeline, we have to ask Farm Boy about whether you like the pipeline or not. Pfizer's already on the buy list, and Merck. I don't not like Merck, but I really generally find that Pfizer is in a better position. I mean, almost every time I look, I decide Pfizer is better off than Merck. Very, very rarely do I ever see Merck where I think, ooh, that's the buy. All right, so meanwhile, let's see how badly I'm doing on my trade. Futures, no, active. Ah! All right, down 180, but I've only got 2. Oh, yeah, what did I say I was going to do? Oh, this is where I wanted to do it. So he's 4 below. I need to sell here. So I need to sell 2 guys here. And that'll bring my average up to 174. See, 6 above. There he goes. Wow, that was funny. All right, so now it's 7 above. So now watch, now I'm over 174. So now I immediately know I want to sell 2. So when we get to 174, I'm going to put my sell order in right now. I'll put another one in just below it because I'm greedy. So now even if it spikes down, and what am I doing then? So what I've done is I've raised my basis to 174. And if we get back to 174, it's going to pop me out. So that's going to mean I'm going to be left here with 3 at 174, and still I'll be left with 3 a little over 174. And then I'm back to a comfortable position. I don't mind having 2 open overnight. I do mind having 4 open overnight on the Russell, because the Russell can pop 10 points on me, and I'll be out $4,000. That'll really piss me off. You know, being out $2,000, I might even ride it out. Being down $4,000, I'm going to have to say, yeah, that's enough. I have to say no mark on that. All right, but we're still under 2,000 on the S&P. So that's my plan at the moment, is to get rid of these guys and hopefully with a nice little pullback overnight. Nobody looks that strong. The NASDAQ is actually looking the strongest here. All right, but still, he's not back to where he was yesterday. That's basically this line. So I don't think he's going to get over that line. He's having trouble. He's failing. So I'm thinking that you are an outlier, and hopefully you're going to pull back. All right. Oh, good night in Ireland. Okay, great. All right, yes, thanks for Deck Mullins, right? Thank you very much for a very good webinar today, and that's where we're going to call it a night. Hopefully I will be able to close this trade out with some kind of profit, and that will give me a perfect day if that works out. And we will do this again tomorrow. So like I said, we're going to be adding to the buy list. And over the next couple of days, I'd like to make, if you guys have suggestions, we're going to look at a bunch of stocks. We'll talk about what's good and bad about them. and we'll find our final 11 candidates for the buy list, or probably the final 11. I don't think we're going to want to go to 50 on it. All right, so thanks, everybody, and have a great day.